Welcome, everyone. Um, Welcome to iVenture at ISB. Today, we are celebrating um, the National Startup Day. So it's a fitting celebration to have Sanjay Nath of Blume Ventures join us today. Um, he is going to be talking about the the investment journey of startups, from the beginning to finally when you actually get some serious money to do something really important. uh, we are going to take it step by step. I'm going to ask a bunch of questions, and towards the end of it we will have audience join in and they can ask questions as well. So rather than give a long introduction of Sanjay, what I'll do is I'll ask him a bunch of questions that will introduce who Sanjay really is and how he got into this whole game of venture investing. So, Sanjay, welcome. And we also have with Sanjay his partner. You want to introduce Sanjay? Uh,
Sure. My Sumangal, maybe you can introduce yourself. I've got my colleague Sumangal, who's a co-pilot with me on all things SaaS, and he's the ISB alum here, not me. So Sumangal, why don't you just say a few words?
Thank you, Prof. Thank you, Sanjay. I'm Sumangal, passed out of ISB PGP class of 22. Been with
Class
Bloom
of
for about
22.
6 months
Okay.
now.
All
Yeah,
right.
class of 22.
Okay. So you are a baby in this game.
ऐसा थोड़ी ना बोलते हैं बिल्कुल।
Sorry. I think Sumangal is muted now. So welcome Sumangal, back with Sanjay. Sanjay and I go a long way back. Sanjay and I were both at UCLA Anderson. I think in the uh, just about the turn of the century. Sanjay at that time was an MBA student, and if I'm not mistaken, I think he took one class with me in finance. But he went on to work for a number of. So tell us before, I think it was 2010, Sanjay, when you kind of jumped into this investment and startup game. But what did you do after you graduated from UCLA Anderson in 2010? And give us a little bit about how this bug caught you.
Sure. By the way, yes, I did take professor's class, and hopefully didn't flunk out where he's called me today to speak. So I guess that turned out okay. Um, First of all, it's a pleasure, privilege, and an honor to be here. I always, in half jest, to say that I'm a quasi and a honorary ISB alum because get a chance to meet professor both here and whenever he visits the US. So it's wonderful to be here and to also have. I want to say we actually have 4 ISB alums inside the Bloom team. I think it's one of the Sumangal probably the biggest alumni community. So it's interesting. Yeah. I think you've asked a very interesting question. I will say that I've seen that some of the most interesting paths in life is actually one where one has not planned fully, or they're not necessarily linear, and that happened in my case as well. So I'll just share. So quick background: I'm a Bombay boy. I happen to be in Bombay right now, but I've relocated to San Francisco. Um, and BITS Pilani undergrad, then UCLA Anderson Business School around the turn of the century, so more than 2 decades ago. And I started my career actually just around the dot-com dot bust when Google and the whole internet economy was just getting invented. And I'll start off on a lighter note. At that time, at the height of the boom, the joke was if you were starting a startup, all you needed was a PowerPoint and a dog. And then at the absolute peak of the boom, the joke was you didn't even need the PowerPoint; just a dog was enough. And spent about 10
And
years.
there were companies like fish.com, right? which had nothing to do with .com, but they rebranded themselves.
Yeah.
I almost rebranded myself as BC.com, but then I thought better of it and
Yeah.
not
So
do it.
absolutely. So of course, from that, the Googles and everything started, and the rest is history. But I spent going back to me, I spent about 10 years as a management consultant across PwC and IBM, and I was very intrigued about entrepreneurship and venture from the outside. And it is, as all of you know, and happy you can DM Sumangal after this. It is not an easy career to break into at whatever level, whether you're a partner or even earlier. So even though I was in Silicon Valley, it was easy to become a VC. And I chanced upon this group called the Mumbai Angels, which you may be familiar with about 20 years
Yeah.
ago. Sasha, the founder, is a good friend, and was lucky enough to become an early member, invested in InMobi and a couple of interesting startups. And I was very intrigued that many of those founders had moved back from the US here to kind of kickstart the India wave. And I came back. I chanced upon met my partner Karthik Reddy, who had also moved back from the US, was also a member of the Mumbai Angels, and that's how we started. So it was risk taking, professor of many levels, coming back to from the US to India into a different career and with a different partner, not somebody who I'd known for more than a couple of years. So
So,
uh,
Sanjay,
yeah.
this is actually a pretty important thing. Maybe not the startups who have already started, but there are many ISB students who are watching this or will be watching this later. This issue comes up to many of them that, when they get an MBA, they become consultant. They go and work for McKinsey or they work for Amazon, Google, whatever. But at some point, they think about taking the jump and becoming an entrepreneur themselves, or in your case, become some kind of an investor. Um, what is that journey like? I think this is a question that crosses, I would say, about 80% of the MBA students who graduate from top schools.
Yeah, it's a great question. See, I think ISB, from what I know, y'all are fortunate in the sense that I think most people now looking for a career are they looking for a career switch, but you're kind of thinking about 5, 10 years, not 2 to 3 years. Back in the day when there wasn't enough work experience at B school, you would do one career and maybe switch many times. Now I find people coming and thinking, okay, let me at least think in terms of a 5 or 10 year window. Um, I think consulting and banking, it's a good place to start because, of course, it pays the bills, and I took that choice too. Uh, but I think what you have to watch out for is becomes difficult. The more successful you get, and the more rewarding it becomes more difficult to leave. Quote unquote golden handcuffs. Again, I'm going to share anecdotes, and I'll tell you another funny story. When I just started from PwC, I was still sitting next to a quite well-dressed gentleman professor from London to San Francisco, and he was wearing a trench coat. And when you're young or younger, you can ask silly questions, but they don't seem silly. Then you're bold enough to ask them. So I think I asked him something like, so if you don't mind me asking you, I'm going to ask you, you're very well dressed. How come you're flying economy class? And now if I asked him, it would be so stupid. And then he says, I'll tell you, he says, no offense. He says, because I'm an entrepreneur, right? The money I save, I'm going to spend on my business or spend on the family. And he says, what do you want to do? I said, well, one day I want to become an entrepreneur. I want to do something different. And he says, just make sure you do it by the time you're 35 or 40 latest, because you'll find all the reasons not to do it after that. And that innocuous and silly situation is stuck with me to this day. I still remember that vividly.
Wow.
So my advice or thoughts are, I think it's good to get different experiences, because what consulting and banking gives you is as two examples, gives you the breadth, which VC also has a lot, right? I mean, we are typically generalists. We have to be great analyzers and problem solvers, as Sumangal is figuring out and slowly mastering. And then, you go broad first and then you dive deep, which I think consulting and banking does teach you. What it doesn't teach you is the skin in the game. And I think this is
Right.
very important in VC. Even if you're angel investing 2 lakhs, $2,000, when you have to put your money out where your mouth is, it's very different from saying, I think this is a great idea, here's a PowerPoint, but are you going to put your money behind it? That's where the rubber meets the road. And I think it's a great example. I tell just students of entrepreneurship, everybody feels that, oh, if I'm going to be participating in entrepreneurship, I have to do a startup. That's not necessarily true. There's the founder's office, there is angel investing, there is mentoring, there's helping out at ISB. There are many ways to get involved. And I think of all those as sort of like apprenticeship school. They're all training ground to one day start. So I don't think you have to necessarily start unless you have a brilliant idea or you found a co-founder to start day one. There are different ways to get involved and then start.
So that's actually a pretty good advice, I think. What you're saying is you can basically get your feet wet in the water a little bit by maybe saying becoming a mentor or maybe doing a little bit of angel investing on your own. Is that what you're suggesting? Is that another way
Yeah.
to dip your feet a little bit?
Yeah, I mean, I know, I think business school itself is fertile ground for ideas and innovation. That's where people go. So there are the folks who will get a brilliant idea, find a co-founder and start, right? So I'm not saying that they shouldn't start, but not everybody has to
Not
start
every.
unless you have a brilliant idea. So it's a great way, feel, to get your feet wet. And, you know, I mean, like date before you marry, that kind of analogy, right? Where you're really getting a rent before you buy, getting a sense of, do I really like this? And and am I aware of what can go wrong? I think that's very important, right? We always look at the glamorous side. I remember years ago, I was at a conference at BKC Sofitel, and somebody from the back, stood up and asked, sir, can I ask you a question? Sure. He says, are VCs human beings? I said, what kind of question is this? So, this whole industry has been glamorized so much. At the heart of it, you're backing, you're taking a risk, and you're a minority shareholder in companies that you can't really control because at max you'll own 25-30%, and you're never going to become majority, unlike PE or buyouts. And you have to be aware of the risks and the returns.
Yeah. Um, I just want to plug in and say that, at I venture at ISP, we are giving a lot of opportunities to all our alums to become mentors in whatever way they are able to. If they're able to give 1 day a week, 2 days a week, a few hours every week, we give them that opportunity. We connect them with startups. And I think that is a good way of doing it. So the next question, Sanjay, if I may persist on that a little bit, in terms of financial stability, before you take the leap, do you need to have some degree of financial cushion and stability before you decide that I'm going to do this?
This is an interesting question. I don't have an easy answer. I think it is good to plan out. Let me put it this way. I think you have to plan out for if things go well, but if also things don't go well. I talked about that. I think a 3 to 5 year window is something, let's say somebody has a cash flow plan. The advantage with this community with ISB is that you have a fallback, right? You had a interesting career before you came to school, and you have that degree, so it's going to be interesting after. Um, in the West, you have a lot, Professor, you have a lot of founders who've made money before, and they do have that cushion to start off with, right? Sometimes they're older and they're veterans. So in this case, that's not necessarily true. I think it is one way to do it is to even put a bit of money in the game, or not take salaries or take lower salaries. So then the investor says, okay, that is some form of skin in the game. But it is important to plan out and know that, if things don't work out in 3-4 years, uh, you know, I'll take another look at it. But the right way to think, if you want to go, you're going all in, then you go all in. So it's not an easy answer, but it's always good to have, like, friends and family to support, right? Which is why the first round is often people who backed you. I've seen actually a lot of founders when they start up, if you ask the angels and the family who backed them, they would back them no matter what, right? They wouldn't necessarily say, oh, you're doing a consumer startup, so I'll back you. But if you did SaaS, I wouldn't. They would still back you. But we can get to this in a different part of the discussion. I also find that some right sizing or sizing around is very important. We find a lot of founders, I'm building something in AI, I want to raise 5 million. Sometimes you raise too much, sometimes you undercapitalize. So that's also an interesting element of discussion.
Yeah. So, being a finance professor, this question always comes to my mind. Should we be really risking our friends and families' money in a startup? Everything we learned about diversification says that, you know, uh, you shouldn't be risking I shouldn't go to my father and say, you'll give me all your retirement money. That's why we need outside investors because they are more diversified, right? So how is this trade-off between sort of bootstrapping versus reaching out early to some kind of angel investors? What do you think about that?
Yeah. There are different classes and kinds of angel investors. Today, there are professional angel investors, right? They're the well-known, the founders, unicorn founders who are professional angel investors. Some of them have their own, obviously, the family offices as well, right? In addition to running their companies. And then there's friends and family. And there are two ways to look at it. We tell some of our family offices that this money that you invest in a venture fund and or in startups is money that you have to be willing to write off. If things go well, and let's say you invest 10 lakhs, that could become 2 crores. If things go well, you can get 20x return. And the advantage that you have, unlike a VC, is you can exit in the next round because nobody's going to ask, why is this angel investing? But they're going to ask, why is Blume exiting? We don't exit early. We stay with the company for a long time. But if things don't go well, this is a 10-year fund. The startup may take 10 years to give you a return. You have to be willing to keep it aside and not worry about it. And there are enough successful examples also. This is a power law. I think many of your students must have read that book. It's very much a power law game. The thesis is that if you're backing good founders with good pedigrees, with very passionate about an idea, who are able to coalesce and bring the right customers, hire the right people, the chances of success are higher. So let me make a bet on somebody I trust. And that's why I said use the word dip a toe in the water, right? If somebody's dead.
So say a little bit more about power law. What you mean is
Sure.
you invest in a lot and there are few that will succeed, most of them fail.
Absolutely. Absolutely. It is multiple things, right? I mean, the 80-20, the Pareto rule, the Pareto principle. And Professor, this applies even to the best investors. Even the best investors with the best platform applies to them as well, right? It's not like this only applies to, let's say, the bottom 25% decile. So the power law basically says that again, 80-20 rule, 80% of your returns are going to come, for example, from 20% of your investments. So the way we manage that is your first checks are spread across, and you're doing many more investments, and then you have a reserve ratio. And similarly for the power law, right? As you're an angel investor, you invest a little upfront, and then when they hit their milestones, that's when you go in deeper. And it is it's very much, if you look at like, I know, for example, that particular fund of Axel, was returned by Facebook, and you have many stories like this. So typically in every fund cycle, you'll have about 5 or 7 companies that make up the large bulk of the returns.
Okay. Now, let me again focus on the investing side and then we'll come to the startup side, how they should think about it. From the investing side, so 2010, you decided, okay, I'm going to go and start learning how to invest. Did you want to specialize? Did you want to say, okay, I'm going to take a sector and learn everything about it? Or was your approach that, I'm going to just try various things and then see which one I'm really passionate about and then specialize? How did you go about that?
Yeah. We had a strategy, and I don't know how many of you have seen, but the files that my co-founder and partner Karthik has released called the Omega files has kind of been sprinkled into the universe. So I think it's a lot of people have, and much of that chronicles this. But we had a strategy. For example, our thesis was there are two Indias, unlike China, and the two Indias are there's the India for India, which is Bharat, which is the Swiggies and the Zomatos and the Healthify Me's from our own portfolio, and then the other is the built-in Bangalore for the world, or Hyderabad, the Pune, Gurgaon, which is the SaaS side, Gray Orange Robotics, and the uh, uh, AI deep tech, what is built in Bangalore for the world. And we said we think it's about like a 60-40 split.
60.
So kind of like a 2/3, 1/3, and we feel that um, you have to have capital for both. And then we said within that, within SaaS, we said there is typical software service and there's deep tech, right? So deep tech is life sciences, nanotech, still very early in India, but robotics, uh, you know, healthcare, like medtech devices and autonomous ground vehicles, and consumer, of course, fintech, healthcare, roti, kapda, makan, sort of the basic necessities. And so that was the thesis. Now, if you look at how we've evolved, Professor, into our fourth fund, now today we are specialized. We are a generalist
Yeah.
platform, but we have 5 partners, and each of them kind of specialized, like much like Silicon Valley. So we have EV climate, and deep tech is one, SaaS, everything SaaS is the second. There is fintech and agri-tech, and then there is consumer broadly. So I think we've evolved to that much more specialized state.
I see. I see. Okay, now let's switch gears a little bit and think about it from the point of view of startups, because I think there are many in the audience who are startups themselves. So let's give them some advice about, funding related advice. I mean, there are other advice, but in terms of funding related. So we talked about, um, you bootstrap a little, take family and friends. Uh, at what stage should you pan out a little bit and start seeking money from professional investors? Or should you really, I mean, sort of coming back to this question about how much of family and friends and foods, as they say, money to start with?
Yeah. No, so this is interesting. I'll also share, first time founder is also like a first time fund. Many of you may also be working or seen first time funds, and first time funds often go to, for example, like a UCLA endowment, right? If a first time fund goes to UCLA endowment, they're very less likely to get money unless they're
Yeah,
no fund manager, because the endowment manager says, what hits have you got? What misses have you got? What
right.
mistakes have you made? And I want you to have made those mistakes with somebody else's money, not my money.
Correct, correct. Yeah.
And think of friends and family as that, the first, because
First mistakes.
yeah, unless you're a seasoned founder, unless you have made your mistakes and proven something before, when you're starting up for the first time, unless it's a really hot idea or very well known, it's good to kind of start small and wet, because I'll give you a line. I'll give the audience a line here, that investors invest in a line, not in a point. And what we want to see very often is, all right, I saw you or interacted with you first time on Professor Bhagwan's Zoom. And after that, we met with Sumangal. And, now we've launched. And you're kind of seeing the trajectory, and you can even have some dips in the middle. It doesn't have to be all smooth sailing. But you kind of want to see, is this a living, moving, breathing animal, right? That's what a startup is. Does it
Mhm.
have life, and is there heart, and, what's moving? Versus if it's a snapshot, I have no way to evaluate it relative to what, right? It's Professor, your PhD and your thesis about macro and about recessions, and going back to history, right? It's over decades. So I think a good example is actually to start small, and show some, like, it's like the equivalent of a first close of a fund. LPs want to see a first close of a fund and say, if you're raising 100 crores, or you raised 25 crores, what do you do with it? Oh, we made 3 investments. Yeah, they're doing very similar, the angel rounds like that. you hit some milestones, and then with those milestones, you go back to professional investors and say, okay, now we're ready. We've this product has hit scale. We've got an initial set of customers, or 1,000 downloads. Our product is picking up in this supermarket, and now we think we are ready to raise a larger quantum to prove that out, to scale that.
I like that analogy a lot. Don't show a snapshot, show a live animal. Show where you started, what you did, what mistakes you made, what worked and what didn't work. And that has a better appeal to investors, is what you're saying. Is that correct? Yeah.
When you're not known and when you're trying to break in, I'll tell you, a lot of our Bloom founders have actually been ex-founders, repeat founders. They've come through referred networks. So if somebody else is willing to vouch for them, then that also lends credits, right? Because somebody you know and that you respect is also putting their money behind it. So sometimes you might actually have a combined round. You may have friends and family angels and one VC, but that's because it's a known quantity. There is some reference point.
Right, right. Um, uh, can you say a little bit about when you're looking at a startup and you look at the team? What composition do you want to see in that team? I mean, to really bet on, let's say, one person who's really passionate and then say, okay, whoever you have, it's your problem? Or do you want to see, like, somebody who's a good engineer, good coder, but somebody who's a good business? Well, tell me a little bit about that.
Yeah, this is really interesting, Professor. I feel that this is the most difficult puzzle, the piece of the puzzle to solve in startups. It's not like it is marriage, with the difference that if you have three co-founders, you have you're married three times, or you have three husbands or wives, right? So it's even tougher, or easier. I would say a couple of things. Again, just using analogies, right? When you find a co-founder and you're that early size of team, there's the whole Amazon pizza kind of thing that I think you order when early size of team, you should be able to, if I get it right, I think if you order two medium-sized pizzas, you should be able to finish it, because if it's not enough, then you're too small a team, and if it's too large, then you're too large a team, right? It's the right team. But I would say when you're looking to find co-founders, I think complementarity is very important.
Complementary is
Yes,
important.
yes. So I think we tend to align with profiles that are like us, correct?
Like us. Yeah.
For example, like, three co-founders starting from ISB, that's a good sign because you already know each other and everybody has the same toolkit. That's a good part. The What you have to watch out for is, is everyone thinking alike? I think at ISB, a business school happen less because people already are shaped and have different undergrad backgrounds.
Yeah. Yeah.
But in undergrad is a little more, no, I wouldn't say dangerous, but you're much more like to think alike. The advantage of undergrad, sometimes you have the biggest deep tech plays, like Pixel came out of Bits, Gray Orange came out of Bits, because you're so technically passionate, right? You've not seen the rest of it. But coming back to this, I would say uh, people who really complement you, who think differently from you. I think of the co-founding thing as a Venn diagram. If you have three co-founders, or you have two, there should be, I think, enough at the meet of or the intersection which pulls you together, but not so overlapping where you're all the same. And very often you'll find, okay, one person does product, one person does tech, one person does sales. That's great. Uh, how different are you all? How do you all push each other? How do you all make decisions? I'm giving you a very nuanced answer. It's the most difficult and important thing to get right. I will also say that don't rush into it. Again, date before you marry, because sometimes people say, "Oh, should you have two or three co-founders?" People have come to us, ask me all the time. It's much better to add a third co-founder.
Okay. Yeah.
No, I will never ask why are there only two of you. But we've seen cases where there are three and one person drops out, and I will certainly ask what happened to the third person. So
Right.
I feel some founders rush into. I've seen, if you remember the housing.com, it had 8 co-founders.
Right.
The other part about co-founders is also it doesn't always this is also tricky. It doesn't always have to be equal, but it should be equitable. And what I mean by that, it doesn't always have to be 50-50. Maybe one founder's put in some money. Maybe one founder had the idea 3 years before the other did. And you have to have tremendous trust. And there are other ways to do it. You can carve out an additional part from an MSOP or ESOP later, right? A lot of this is trust, and it can come over time. So sometimes, it should not be rushed. It should not be rushed. Okay, there's a startup pitch coming, and let's build a team and let's go. I think it
Let's
has.
say 5 or 6, yeah. So, but I worry if somebody comes up with just one founder. Uh, uh, I think the magic number is at least two. Do you have a view on that?
Again, it's a interesting and a tough one. We used to earlier have a thesis that we would not back single founders.
You
Uh,
used to have that
that
thing.
we would not, and
Yeah.
in most cases we've held to that tag, uh, but we've seen some very seasoned senior people who have a very good thought process and say, this is my idea, I'm starting, I have a very senior team, I have a team of 3, and I have allocated a substantial amount of equity, but I want them to grow into that, because you also don't want, very often, otherwise you have 3 co-founders and it's artificial because everybody knows whose company it is and who's really driving it. And sometimes that's also not great. So we've also seen different combinations, one founder and a very senior L1 team. They're like almost like there's a CEO and 3 CXOs. But typically, I think at least 2 is good because, Prof, what, you start drinking your own Kool-Aid.
Yeah, right.
And it is very difficult for, I'm using the word subordinates, but you could call it whatever, just your L1s, to give very tough feedback. If something is not right, because that person's equity, that person's paying your bill. So yeah, I would say uh, somebody to make sure that you're not drinking your own Kool-Aid.
Okay. Um, a few people are sprinkling questions, so maybe I'll go to them, if that's okay. And then we'll come back to talk about other ideas as well. So here is Pankaj Pandey, who's asking this question that I'm sure has been asked many times to you. Um, this trade-off between growth versus profitability. Um, in the current market scenario, he's asking, what are VCs looking for? Are they looking for growth or profitability? And is there a horizon, uh, you know, over 10 years? Well, is there, are there any simple heuristics or insights you have?
Yeah. Prof, I'm going to give you a part B school answer also. A lot of VCs are looking for profitable growth. That makes sense.
Yeah, but that's
Uh,
possible. Yeah.
but let me say this. I think it depends on the context. If you're looking at, let's say, food delivery,
You
or
you say something like depends on the context, and
depends.
you get fired these days.
Yeah. No, so let
Yeah, I'm talking about the big brouhaha in the US about
oh yeah, of course, with absolutely with
yeah,
the
but here it does depend on the
yeah,
context.
I'll share this, because if it is, let's say, in the realm of consumer delivery, and you're spending to acquire your, it's a CAC driven business, and you're really spending to acquire. I think we like founders who are thinking about what's the right for the business and what's their mindset versus what's the right for the investor. I mean, not to make a comment on Byju's, for example, but now it's public news. You've seen the joke floating around is not about them, but there's a unicorn that's actually valued at a unicorn, right? It's valued at $1 billion. Um, because at some point you don't have to get profitable today, but there has to be a path to that. We talked about investing in a line, not in a point. Is there a path? The classic MBA case study question. I remember, Professor, when I was in LA, I remember one of the consulting firms would come in and ask, how many gas stations are in LA? How many petrol pumps are in Hyderabad, right? And there's no right answer to that, but it's a thought process. So to answer this, that what is the thought process to get to profitability? What is the right way to balance profitability and growth? I think in SaaS, for example, it's much easier because we find that after a certain point, you don't have to keep raising rounds. Your customers kind of become your investors, and once your product is out, you have high gross margins, easier to get there. In consumer businesses, much more difficult. Definitely, there's much more scrutiny on on cost structure. I'll tell you, many startups have rightfully cleaned up house. Remember, I mean, for the audience, that venture is really about cycles. It's about venture cycles, and you have ups and downs. And 2015, 16, we had like go-go years. Again, I would say 21, 22. In the pandemic, I remember, we had digital tailwinds for many of our startups. An Academy raised 3 rounds that year. Facebook, Google, the others, because tech moved entirely to online, correct? It's huge digital tailwind for them. But all these startups have to look at it. So I would say it is balancing both. You would be quite, surprised and happy to hear that at Bloom, uh, we spend time with our consumer startups on, we're saying actually IPO preparedness, think like a public company. We bring in senior public equity investors and also entrepreneurs who have taken their companies public, and this is how you have to manage. This is what the public markets are going to come and expect, and know this 5 years before you go public, because you're not going to switch on one day and say, "Oh, I'm going to do this for the sake of." So to answer your question, um, of course, growth is important. You're investing $1 to get $5, but not at the expense of. We don't. I think we are watching, as Sumangal would attest to, we're watching much more now, different aspects of burn, and all those financial ratios that that B School is teaching are becoming much more important in today's environment.
Yeah. Both and Sumangal and I, we wrote something for Outlook Business, their startup edition. And I wrote that article where I said, well, when it comes to cash flow, you have to be able to see the cash flow. You have to be able to see the light at the end of the tunnel. You need not be at the end of the tunnel right now, but at least you have to be able to see it. If you can't see a path, that's what you're saying, then you're in trouble, right? Um, okay, so there are a couple more questions. I'm going to read them out to you. Ankur Sharma is asking, what are your thoughts on the Indian deep tech startups where you're making for the world, but the primary market is where the primary market is developed world, but Indian market provides kind of the initial product feedback.
Sure.
How
So
would you be as VCs will look at startups like that?
absolutely. And Sumangal, I'm going to turn direct. I'm going to play assistant professor and direct some of these to you also. But I'll take, there's a SaaS one that you can take, but I'll take this deep tech one. This is a very interesting question. I'll give you two examples. These are companies that you're maybe familiar with: Gray Orange Robotics, that came from my alma mater, from BITS, and Carbon Clean Solutions, that came from IIT Kharagpur. Both these deep tech startups were started in India itself, straight from college. And Professor, to your the question's point, the proving ground was India for both of these. So it was helpful, but we found that in Carbon Clean Solutions case, carbon emissions then about 10 years ago weren't really valued, and it didn't make sense trying to convince CXOs that you should pay for this, for carbon capture, because there was no financial incentive. Even if you looked at robotics, yes, you could automate warehouses, but labor is cheap in India, right? So your alternative to robots is labor. But the minute they both moved overseas, in Grey Orange's case to Southeast Asia first and then the US and Europe, where labor costs are very high, and the warehouses are larger. If you look at the H&Ms and the Amazons of the world, the warehouses are massive. The scale made a lot of sense. So in Carbon Clean Solutions also, they actually moved to London, and they were housed inside the Imperial College lab for the longest time. And now Chevron has put a big check. So suddenly they had to go to the market where customers valued them. And I think that applies here. I think you have to go. Yes, I think we're very, very bullish on deep tech from India. We have ethereal machines, which is like machining, manufacturing as a service. You have Ati Motors and Grey Orange, which is robotics as a service. So SAS and deep tech are coming together, and Bangalore and Hyderabad, Gurgaon, Pune are becoming the hubs for deep tech made in India for the world. But you also have the sales, and the CEO has to be close to the customer. You've got to make sure that you're getting a bang for the buck. They're paying for it. So in both those cases, the markets were outside. But there is a lot of I see government spending opening up for drones and defense tech, and we're seeing Idea Forge, right? Idea Forge did a IPO in India, and we're seeing a very large local domestic local demand market as well for deep tech. So I would say it's both here and overseas.
Excellent. And you said something that I wanted to emphasize just a minute ago. Think like you will be doing an IPO in 5 years. Think about it now. I think that's a really good advice. Even though you're not public now, think about what it is. And the person who did this a lot was Narayan Murthy. If you remember Narayan Murthy, when for Infosys, he didn't really need the money because his company was generating
Right.
enough cash. So there is really was no need to go public. But he said going public provides that discipline and governance, and he put that in the DNA of Infosys right at the beginning. And I think that's actually a pretty important lesson. So thank you for bringing it up.
Great.
Okay, here's a question from Vibhu, and his question is: so suppose you have a cross-functional team, and let's say there are four of them who are in the founding team, but there is one founder with 50% equity and others with little equity, but mainly sweat equity. What do you think about that?
Yeah, it's an interesting one, and we do see that. I'll have to admit it's not something we've not heard before. Again, to that point, I would want to hear from the founder why that is, and they may have a perfectly valid explanation, but it's my right to ask, and we do that. I think there are a couple of reactions which we like or we may not like. If it's a single founder and they have not shared equity, it could show they want to run a very tight ship, which is good, but also that they're not open to feedback, ideas, and how are you going to attract the best team? You're only going to attract employees, and employees don't want to work for a startup. You don't want, right? You want every startup person to get up in the morning and think that this is my company. Maybe I own 1%. I don't own 50%, but I own 1% versus I'm an employee. That's one. If they have plans to allocate, let's say, an ESOP and MSOP and expand that based on milestones, like sometimes you'll find founders that want to keep 20-30% for that based on milestones. That's fine too. So it's not a slam dunk no. I think what we are trying to find out is what is the intent behind that, the 50 and the rest of it. But generally, unless it's a, really proven founder who has a very good plan, that's not necessarily the best thing. We like to have it at least a little more equitable.
Okay, all right. Here is somebody asking a question which is very particular about his company, so I will not put it in that frame. We're going to ask the most general question he's asking is this space of cyber intelligence. Cyber intelligence, AI forensics, is the Indian VC ecosystem open, comfortable with that?
Yeah.
Are they
Yeah.
looking? Yeah, okay.
I'm going to look at my younger and more intelligent colleague to take that question. So Sumangal,
Okay.
got this.
Sumangal, please go ahead.
Thank you, Sanjay. I think our thesis, at least in terms of cybersecurity, is that there are a lot of opportunities that can be built out of India. Uh, Generally speaking, if we're talking about cyber forensics or AI forensics, I would say that for SaaS and security in general, India is a great place to build out of, but the go-to-market in terms of where you're selling, the focus matters a lot. because the 70% of software spends are in the US. So you need to really think about where you're selling your product. Building it out of India, obviously there is, it's a perfect place to build out of, but definitely think about your go-to-market. In terms of VC interest, I think we are bullish on companies that are being built out of India for the world in security, in forensics, etc. So yeah, I hope that.
Okay. Um, I'm going to ask this question that Ashok Deshmukh is asking, which is the question about are there things that first-time founders and do when it do fundraising all the time, but you wish they did not do that? In other words, there are the common things people do that they should actually not be doing.
Yeah. Sumangal, do you want to start with that? Then I can add to it. Just
Yes, I think I would say that this is a very nuanced question. I wouldn't say that there is one thing, two, three things. I think it's important to not get lost in the glamour of fundraising. It's important to think about why you're raising funds, and also important to think about the valuation at which you're raising, because especially if you look at a hot space like AI SaaS, for example, right now, we often see founders who are excited to raise at valuations that are maybe a little too high, and that's a common mistake among first-time founders that I've seen, that it's easy to get carried away by the excitement and the interest from the market. But it's also important to think about whether you're raising it at a valuation that you are at right now, or do you need to grow into this valuation 2 years later? What does that line look like Sanjay mentioned, right? So I think that's important.
yeah, I'll just add to that. That's a great starting point, Professor. I'd say one is I th I'm not calling them mistakes, but two things to just be self-aware of is one is um, falling in love with the technology too much, in the sense, yes, you're trying to disrupt the world, but remember the other person is usually a generalist and they may not be a specialist, and spending too much time on the tech product versus thinking about what the business outcomes, how the user will use it. I think the importance of customer discovery in the use case is very important versus just the
Yeah.
technical. That's one. And the second is using your cap table or names. This we see the most. I think this is a no-no. Using the cap table and names and your sort of powerful board of advisors, to overshadow actually what you're building. Like I'll just give an example. Uh,
Okay. So
uh, uh,
name dropping. Don't do name dropping. Show the product
well,
first.
name dropping without context. Like
Yeah.
we all know how difficult it is to break in. It is, right? I'm here. ISB has a fantastic brand. We have a relationship. So Mangal's ISB, of course, I'm going to be here. It's difficult to break in without that. Um, uh, uh, but very often we find that on a Zoom or on a in a meeting, there'll be one founder, you'll have one banker, you'll have an advisor, and the advisor is very well known, and the advisor is speaking sometimes more than the founder. And I'm
Mm,
like, I'm not backing that advisor, right? I'm
right.
backing the founder. I can't tell that senior advisor, I would like you to talk less and the founder to talk. But I think these small subtle things are very important because you're actually backing that. So yes, they do it with good intent because you're appearing stronger and more fundable. But I think those soft signals are very important.
Very, very good. Very specific advice. Although you are the funders, you could tell the advisor to be a little quiet, don't you?
Yeah, like everything in life, it comes back to how we sort of manage people and deal with it, and we'll give
Yeah.
the feedback later. But more important is that founder has to be self-aware of that and how to bring them in. And the people who do it very well. Uh, oh, by the way, who are your advisors? Oh, by the way, these are these folks. Happy to introduce you, right? There are always ways to do that.
Right. Excellent. Excellent. Here's a question Dinesh is asking, which is sort of it's a question about his company, but it's a more general question. Let's say you are already achieved profitability and you have, let's say, revenues of about 20 crores, and now you are going to expand. and you need to raise money for that. His question is, are the valuations going to be tethered to that 20 crore profitability you have right now or revenues you have right now? Or are they going to be determined by some sort of a future growth options?
Absolutely. So, you have all kinds of frameworks, right? You have the DCF, discounted cash flow, and many, many different ways to value a business. I'll say there is there's a inverted pyramid, or a pyramid, if you will, inverted pyramid, where your when startups start, there's a very high mortality rate also. Between seed and pre and A and B, you get funded, and then there is a premium. I'll give you just an example, and Sumangal can also add in SaaS, for example. Let's just take an example. There are today, I think SaaS Bhumi says, I think there are about 80 startups which are north of 100 or of 10 million ARR. And I think about 10 that are 100 million ARR. Now that bar is very high. The 10 million ARR is not easy to reach. The minute you cross that, to answer your question, then you have a bit of a premium and command the founder of the valuations, because there's a lot of capital chasing few deals. But at the pre-stage and A stage, I can't tell you every single startup that pitched to Sumangal and me is, we're building an AI, we want to raise 2 million, we have, 5 initial customers. Very often, of the first two is like Flipkart and two big Indian customers, and they want to go out to the US. We're going to be very realistic in valuing those companies because they're very early. But the minute you cross that, then you do get better multiples, to answer the question, right? You will be valued at the future rates. Then we look at public comparables. So it depends, I think, what stage of the company you're at. And Sumangal made an interesting point. It is actually, founders should not be fixated on valuation, because it comes back to bite you. I'll give you an example. Won't name names, but in all the VC companies' portfolios, today we have seen flat rounds. We're seeing even down rounds. So it means that 2 years ago, if you were obsessed with, and the founder wanted a really high valuation, it was overpriced then, or rather it is being viewed as overpriced now. And because you overpriced and mispriced it, you're going to get a flat valuation now, versus getting a realistic valuation then, and then getting a healthy bump up now at the next stage. So I think that and one last thing you made, I'll say this, a little controversial. I think there are three kinds of capital, especially early on. There is angel capital, there's good capital, there's good money, there's dumb money, and there's also nuisance money, right? Actually, dumb money is not bad. A lot of people say, it's dumb capital, it's okay. You just need the capital. You don't need anything else, just take it. But nuisance capital is the worst, where investors then tell you how to run your company.
Right.
And no, this is not the right way. Earlier company was more successful. That's the worst, right? I don't want other investors telling my founders how to run it. I'm backing the founder. So I think I would really tell founders to be careful who you take your money from very early. It's the most important thing, who you have on your cap table. That's also a marriage, by the way. Not just your co-founders, but the people you're married to, you have in a cap table, you're also married to.
Yeah. Okay.
And sometimes you can't get them out.
Right. Okay. Here's a question from Parag Agarwal. It's about, what's the right time to seek funding? So he's saying, for example, we are in elderly clear with wearables and cloud and AI and stuff. They're doing pilots and stuff like that. But to really, get this thing, they need to grow. They need to hire a big team and, have some tech and stuff. Is this the right time to ask for external funds, or should they continue to bootstrap and go with the debt route? He's asking.
So, Mangal, why don't you take that? Go ahead.
Yeah, I think the ecosystem has matured enough now that there are investors at every stage of the company. There are investors who will write a check with nothing but a team and a presentation. And there are investors who will look for, let's say, $100 million in revenue. So I think the ecosystem is mature enough that you have all of those options. I think what I would say, I would sort of flip the question a little bit. instead of thinking of are we asking for funds too early, it's important to think about one, why you're asking for funds, like what is the deployment strategy once you raise a certain amount, and secondly, what milestones are you planning to reach with those funds? I think that's a more important question, which at least the investors will look for. And if you think that, like Sanjay said, who you have on your cap table is the most important. So if you think that it's not the most important for you to raise money right now, you will be able to hit your milestones without that. That's obviously a path to take as well. So it's important. The why is very important.
All right. Let me go to this question from Vinay Kolusu. He's saying Industry 4.0 in smart manufacturing. What is the likelihood that, um, with respect to Indian market in specific, um, there will be investment interest?
I'm just looking at the question. What was the space again?
Industry 4.0 is in smart manufacturing.
Yeah, I'll just take a attempt at it. I mean, Vinay, hi, good to see you. I think smart manufacturing is a very interesting. I think that space a very interesting boon for India. Certainly, people were always talking about China as the manufacturing hub and India only doing products and services. But we're seeing that happen now. You're seeing, the likes of Foxconn, and you saw Nvidia here. Huge boom, right? With the incumbents and the giants. Also on the startup side, I mean, we have Gray Orange Robotics, we have Ati Motors, we have Ethereal Machines. So I think the broad answer is, I think it's a very interesting area. Even more interesting if we can leverage India's labor arbitrage, cost arbitrage, the talent advantages to export it to the rest of the world, correct? So, for example, if we can do that not just for Indian clients, aerospace defense, but also for overseas, and you have higher gross margin. So, yes, I think the broad answer is we're very bullish. So, Sumangal, anything you wanted to add to that? We see, I mean, deep tech and smart manufacturing is also an interesting to Bloom.
Yeah, I don't have much to add. I think it's an area of interest. Industrial IoT, smart manufacturing is, um, we do have a specific team that looks at these areas and it is of interest.
Okay. Sheetal Goel is asking, how do you look at teams of founders where founders are in different continents? Let's say US and India.
Yeah, it's interesting. I mean, right now, as a founder, I'm on a different continent most of the time, but I'm spending more time in India now. It is, I'll say that I think culturally, I think one of the things is that how do you handle culture? It's not easy when you're not in the same place. If you have founders who have had a strong working relationship before, then it's very different. But if you're a first-time founder, unless you can make it work, I mean, Sumangal and I have one of our SaaS companies, one of our best SaaS companies. It just has managed to make it work because it's a fully remote culture, but the founders know each other very well. In fact, they know each other from high school and then college and all the way. So they have tremendous trust. But otherwise, it's a remote culture. I think I think then it comes back to the first question we talked about, the roles and how clearly the roles are defined. Let's assume the three founders. One is in North America, one is in Southeast Asia, and one is here. If the market is the US and the founders is building the sales team, then it makes sense because they're the closest to the customer. The engine is very much in Bangalore, Hyderabad. Building from here makes sense. And for some reason, there is a reason to be that it can. But I think what we're finding is that offsites and the working days in office are actually less for work, but more for bonding and more for really finding out what's happening.
Yeah.
So I think that should not go away. I think fully remote is not as easy. Hybrid is okay, but unless there's specific reasons to do it, then that's fine.
Okay. Here's a question by Parikshit. What is your view of startups that are getting incubated with incubators and accelerators? Specifically, how do investors think about the equity dilution that usually entails? So, if you go to an incubator takes 4% or 3%. By the way, I venture at ISB takes 1%, very small. But in general, this question of equity dilution when you go through incubators, what is your view from VC's point of view?
Yeah. I think it's not a one size fits all. It all comes back to the value add. I know that I mean we're unless it's a unreasonable dilution, I think there is value. There's tremendous value in learning across, from other startups that are in the incubator. I mean, there's the whole kind of YC model in one place, using the infrastructure, using the facilities, especially like for deep tech, where you have lab and infra and hardware, and you have access to professors. It makes a lot of sense. It comes back to the value add. I've also seen on the other side that then there are just the key question to ask is, if you had to take this, would you do it again, right? Would you go back to the same accelerator, and would you refer your friends to it? If the answer is yes, and then it makes sense. So I think overall, if it's not unreasonable, it does add value because it gives you that spark to start. I think the initial spark, the ignition, is very, very important. The value of seeing others who are also on the same boat is inspiring, right? You're not in this alone. So I would say it's a good thing.
So with iVenture at ISB, I usually tell people that, if you're taking 1%, you should ask yourself the following question. This is the question about value add. If you think you're valued 100, and by coming to us, you'll be valued 101 or more, then you should take it, right? I mean, it's a simple valuation calculation. Okay, here's a question by Dr. RV. Is India ready to accept AI-based therapies for autism and special needs and elderly care?
Sumangal, I want to direct that to you, please. I know early days, but go ahead.
I think there are a number of companies that, again, we have a specific team that looks at healthcare and deep tech. I do know that there are multiple applications of AI in terms of genomics, in terms of diagnostics, and also in terms of specific conditions that they are looking at. So there are multiple companies in this space, and that's definitely an area of interest.
Okay. Ojasvi Singh is asking that if you have a startup where there is a strong competition, but we think we have created a better product and the market is saturated, competitors have already raised funds, would it be easy to raise funds for us, where you're getting into a market where there is a lot of competition, but we think we have a better product? And then how do you think about valuation for such a company?
Yeah, it's a classic, and it's a very valid question. I mean, innovation and venture capital thrives on competition. I mean, almost every startup that is pitched to us, we you see the famous two by two quadrant. You see names and you see the startup in the top right, yeah, and they've not even raised funding. We like that aspiration. And it's true. Yeah, folklore knows it that Google was not the first search engine. Many of our SaaS startups have dominant incumbents in Silicon Valley. But I think, okay, so the key is, how do you convince others? How do you convince the ecosystem that your competition is better? Customer reference is powerful. I think some tactical or practical examples here. We tell, when we're in the board meetings, we like to see if there's an example of switching costs. Let's say, you have two incumbents and you're going after them and you believe your competitor is better. I'm not going to take your word for it. Is there a customer that switched from an incumbent to you? Do they know why they switched, and do you know why they switched? And then you have practical examples of that. So absolutely. I mean, every single company, portfolio company of us has competition. That's fine. Is there a key? It can't be a fluke. Do you know why they're coming to you? Do you have some element, some superpower? It has to either be ease of use or sustainably lower cost or something that that you can prove, and then you can be backed. So if you can show it, absolutely.
Okay, here's a question by Shiva. In the fintech landscape in India, focus on SaaS versus TSP. What areas in fintech technology do you think are trending that will have a VC interest?
This is more about fintech technology than, I guess, consumer lending and all that. I guess this is about like a
Yes, Sanjay, that's it. That's what it is. More towards offering to the banks as a solution rather than consumer lending.
Got it. So Sumangal, you want to take that? That's a little more of an SMB enterprise sort of question.
So we do see companies that our team is talking to in terms of fintech infrastructure, in terms of technology solutions for banks and financial institutions. I think there is definitely scope for companies to be built out of India for the Indian market. But we also see that some of these do have plans to expand to neighboring geographies as well. So while India as a market is big enough in terms of fintech solutions, I think one of the aspects to think about is, do you want to expand to the wider Southeast Asian market? But I mean, reading the question specifically, um, there's no, I don't have a specific point of view in terms of how you should position yourself. I think if you're solving a value proposition for a customer in the financial service industry, then that's your positioning. So, yeah, that would be my answer.
Okay, Arjun is asking, what's the right time to onboard the board of advisors?
Interesting. I don't know if there's a right or not right time, but so couple of thoughts here. I'd encourage founders to think that it's not like you have no one and suddenly one day you have a board of 5 advisors, right? Um, I think in interesting ways that who are your sounding boards who are with you along the way. And actually, some of those sometimes are better one-on-one relationships. Prof, I'll tell you, sometimes the board of advisors don't know each other necessarily, and it's not a bad thing. It's not like 5 people have to come together and advise you. It's one-on-one relationships, and you can always add them on. I think the way I think about the board of advisors, they're sounding boards who know you individually and they're like an extended, very early co-founding team that is dispersed, but that's backing you all the way. So there's no right or wrong time. It could be like from day one itself.
Okay. Here's a question by Sheetal Goyal saying that, a profitable company, one co-founder is in India, one is in the US, and where should we raise money? In India or in the US?
And any more context on that startup? I mean, what space? It's a SaaS startup or
So
just
Sheetal, you can step in. What kind of startup is this?
Yeah, hi, am I audible? Yeah, this is basically an education oriented, more into the STEM training for K1 to 12 segment.
And where is the market? Is it India or global or a bit of both?
Currently, we have based in India. We have like 2,000 plus students in India, and now we're expanding to US. So basically, the services will be given by Indian offices. The new customer base will be in USA market.
And one founder is in the US, you're saying?
Yes, yes.
Honestly, I think today the interest in India is so high, so sky high that global investors are looking at it. Doesn't really matter. I think you talk to, all good investors, and you see, who's the best. If the market is mainly abroad, then you may want to talk to investors who can help you there. If it's domestic, you talk, but it depends on the size of the round. Today, there are 2, 3 investors on the cap table, so it's not either or. I think you just and also there are a lot of edtech specialists, so you could even talk to investors. So I think just talk to everyone. Today, people are so bullish about India. We don't have to be defensive about it. So a lot of Indian investors also would be interested.
Yes, yeah. Thank you so much. Thanks.
Okay. Rajat Pandya is asking a question. What's the best way to onboard a strategic investor? and what milestones should we set for the partnership with them?
Sure. This is an interesting one also. I think this category is becoming more and more important and strategic, if you will. I'll give you some examples. We have a medtech company that has a large medtech global manufacturer that has come on board the cap table. They're helping them because the startup's AI software could be distributed, right, by the medtech global. So it is making a lot of sense. You have investors like Qualcomm and many studies that are coming in. I think at Series B onwards, it makes a little more sense because you don't want one strategic investor to shape the company and eventually just be a captive. You don't want to get them too early because then, strategic investors don't care as much about financial returns, but have strategic interests, and you don't want a startup necessarily to get too close to one. But I think from Series B onwards, it does make sense because they also become customers. They can take you to their customers. And it is actually very important category for those who know. Many strategic investors don't lead rounds; they'll co-lead. They will, wait for it to be priced and come in, but they add a lot of value because they can be a channel into their customers and their network. So I would say more like at growth stage is probably better to go to them. On the other hand, they also have accelerators, right? Your Cisco and Qualcomm and Motorola have accelerators. So in one sense, they're seeding these startups, and then they can come in as a growth investor later.
Okay. A few more questions to go down. Gaurav Dave is asking, how important is the age of founders? 25 to 30, 45 to 50. Is it important?
I'm going to let my younger colleague take that question.
So, to be honest, I think we've had founders ranging from anywhere from 21 years old, 22 years old till 45, 50 years old across our portfolio. So, I would not necessarily say that that's a criteria in any way. I think it's important to go back to why the person is starting up. What is their sort of ideal end state look like? How many years are they willing to build this for? So I think a lot of times, if a company is raising seed money, they don't realize necessarily that it's an 8 to 10 year journey, which means that they need to be willing and be ready to build for that long and build sort of for the long term. So I think it's important to think about why the person is starting up and why at that time and how long they want to build for, more than the age. Age is just a number.
Yeah. Yeah. Prof, just to add to that, I think it's a great question, and there's no one answer. If I look at a Pixel or if you look at Google, starting straight from campus, and you'll see that a lot in deep tech in those areas. But then, Larry and Sergey went and got Eric Schmidt, which is amazing, correct? Because you really have now a true sounding board who came in later. We don't have any biases at all. I saw a question also around gender bias or things like that, which are very extremely important. And we don't have any of that so. I think we're very excited just to bring in the diversity angle. Traditionally, we've not had enough women founders in general, and we've not had enough women founders in STEM, especially, right? Especially in very deep tech ideas. But that's changing a lot. We've backed a lot of women founders. We have a lot of women founders that pitch to us. Diversity of all kinds. So we don't have any biases. But I would say what youth obviously brings us the energy and the passion very early in a space. And we like well-rounded teams. Sometimes we've seen, where the main founders were in their late 20s, but they've onboarded a CXO sometimes who's 40 or 50. But who brings in the depth. So we really like openness. You have to just think about culture. So no answers, no right or wrong answers.
Okay. Here's a question about how to prove a product market fit. Is there a framework that you use at Blume?
Sumangal, you can take that and you can refer them to Sajid, who is, I think, writing a book and a blog also on it. But you go ahead.
Yeah, absolutely. I think whoever has asked the question, please do look up Sajid Pai. He's one of the partners at Blume. He's done multiple deep dives on product market fit. He has multiple frameworks written out in the public about um, thinking about product market fit for an early stage startup across various sectors. So that's a great resource. Would definitely refer you to that. In terms of like giving you an answer, I would say that product market fit is there isn't a single framework. The I would say the answer varies depending on what sector you're building in. For SaaS, for instance, we might look at a certain degree of traction, a certain degree of growth rate, certain number of customers, retention, etc. In consumer, the answer might be different. In fintech, the answer might be different. So there isn't like one unified framework.
Okay. Sachin Bansal is asking, are there any advantages or disadvantages of seeking funding from a family office? And how to manage that relationship?
Yeah. Today, there are a lot of institutional family offices that are setting up, which is a positive thing, and a lot of domestic family offices from India. I think as long as I think the good part is that there's entrepreneurship to be learned because one has access to. I mean, I think somebody was talking about Narayan Murthy earlier. You have Catamaran Ventures. If somebody has access to Prem Geo or the proprietor on it somehow, that's tremendous. I think what you have to just look out for and be aware is that there shouldn't be like a strategic direction to steer the startup in the necessarily in the way of what the business is. So I think you have to just I think for startups I just say that remember if I'm I'm an investor, I'm coming to back you. I'm not coming to back your fellow investors, right? I care that you care about the company and not necessarily my needs and the others' needs, right? This is not a consensus and a democratic business. This is the power law business. There should be single-minded purpose. So we are the cheerleaders and supporters, not the other way around. And I think nothing that distracts or detracts from that is good. So yes, family office is great as long as there's a Chinese wall between the family office and the family's business. But there can be synergies also. There can be synergies, which is good. If they're a customer, that's great, but you don't steer it with it.
Okay. I'm going to merge two questions from Rachna Gujral and Akshay Malhotra. They're asking, what is the sector flavor of 2024? Specifically, they're asking question about the pet care boom that you see in India. Is that a bubble that's about to burst, or is it likely to stay? And Akshay is asking, what is your view of investments in agri-tech and agriculture? And in general, are you seeing trends in 2024?
Yeah. Sumangal, go ahead. You can take it.
I think I would refer you to our Indus Valley annual report that will be out in a couple of months. You can look at the 2023 version, and the 2024 version will be out in a couple of months. I think that report will probably answer questions around specific sectors like agri-tech, pet care, etc., in a lot more detail. It's focused on India and the Indian market, so I think that's a better resource to refer to.
Okay. Himanshu is asking this question. What if you get this feedback saying, great idea, great product, great insight, but you're ahead of the time? Is this a euphemism for saying, go away, we don't want to talk to you? Or is it really saying you're ahead of your time? Ahead of a time is okay, isn't it?
Yeah, I mean, it's interesting, right? I mean, Elon is wanting to send people to Mars, but he's Elon. Of course, he's ahead of his time. It'll happen someday. So, I mean, the future is dreamed up by visionaries. I think there are creative ways to find some validation. Sometimes the validation may not happen in India, or may not happen on the doors you're knocking on. It may have to come from somewhere else. I think we have this sort of fascination. Suddenly, we get validation from Silicon Valley or from somewhere else, and we tend to believe that, or we say, "Oh, no, this is not interesting," and then tomorrow you hear the classic FOMO that somebody from New York or Singapore has backed this same startup, and you say, wow, what did they see that we didn't see? But I think the onus is a bit on the startup. So it's two interesting thoughts. I think the onus is on the startup to show that validation from somewhere. uh, Sometimes the onus is also on us and the founder to educate the investor a bit. So if you go think deeply about this, usually investors will invest when they if they're not sure, or if they're afraid of what they're getting to, they usually don't invest. And this is about people and egos, right? Investors are not going to say, I don't understand this space. So it's your kind of very creatively you can educate them. So you can share articles, right? You're saying, I'm inventing the future, believe me, and give me money now. And they're saying, no, it's too far ahead. Okay, here's some proof points. Here's a professor who's written about it. This is being done in Finland. We think these are the parallels, and this will happen in India. So there's no right or wrong answer, but I think you be at it. I think timing, though, is important. In Fund One, we backed like a precursor of housing.com, which was a very interesting idea, but we backed the wrong founder. But the idea was a little early and the timing wasn't right. And then suddenly you saw, Geo take off, and you say UPI, and you see the rails were built, and then the same business model but with different timing works. So sometimes it's also timing. But I would just encourage founders to be creative and find different ways to show validation, versus just saying that, I'm going to change the world.
Are valuations different if the company is headquartered in India versus in the US?
I think this is people sometimes overplay this, the where the whole core set up. I think it depends on really where the market is going to be and where your customers are. And if you're truly a global company, what I mean by that is it is so easy to set up a US company. Founders are sitting in India, they're selling to Indian customers, they set up a US company. Doesn't matter, and it doesn't make any difference to me, right? But uh, if you're selling overseas, if you have high gross margins, if you have a different kind of talent base, then it can. Um, I would just tell founders, don't be obsessed about valuation. I think broadly, we are just seeing between 5 to 10 mil, sometimes a little more, sometimes a little less, is a broad benchmark. I'm not saying that we don't fund below or we don't fund more than that, but eventually just peters out. Yes, if you're an ex in the Valley, if you're an ex Google, DeepMind, and you're coming out, with you're an ex head of AI research, of course you're going to command different salaries and different valuation. But in the Indian context, um, not that much.
Okay, two last questions. One is a question about agri-tech and precision farming. The question is, if you want to hire to expand really, really smart people, uh, how much of the equity you should set aside for ESOPs?
Okay, and then agri-tech is the next one. Okay,
So the
so
question, this is about agri-tech and precision farming.
oh, it's about agri-tech precision. Okay. I'm going to give a broader answer. I mean, we have a company called Nico Robotics, which was earlier Tartan Sense, which is exactly in agri-tech. But the answer I'm giving is a broad answer, not just for that industry. Um, I would say, again, benchmark depends on how many co-founders are there, but we like to see ESOPs of at least 10%, right? At least, sometimes even more. Now, if you're a single founder, you may want, I mean, the ESOPs may have to be 30%, because, or if you're, one main founder and then just very senior level hires, the ESOP should be more. But other than that, I would say at least 10, 15 is like table stakes. Uh, I mean, what does a startup have to give? You don't have money to give. The only thing you can give is equity and a potentially valuable startup tomorrow. How are you going to get the best talent? You have to pay them something. If you can't pay them salary, you have to give them equity. If you don't pay either, you're not going to get good talent. So I would say, ballpark of that much.
Okay. One last question. What is your view of grants for early stage founders? And yeah, what if the question is, what if the grant Mentors are not, or grantees, I don't know. The people who make the grants are not futuristic enough.
I mean, grants. I mean, grants in a sense, it's free money, right? So
Exactly. Yeah, take
unless
it.
unless there's strings attached, and what are those strings that are attached? It can be incredibly helpful. Like, I mean, I think carbon clean solutions early on, especially in deep tech, you get a lot of grants, and that's great. You know, Michael and Susan Dell Foundation, a lot of the foundations are in the business of giving grants, and they fund particular ideas. It's great to get it. It is quote unquote free money as long as there are no strings attached. Um, but it the interesting part about it is that it also can make you comfortable. Just as an example, you get a grant of 500,000. They're not on your board. It's not You've not diluted any equity. The interesting part about diluting equity is makes you responsible. You are responsible for OPM, other people's money, and it is that culture that this is not just your company. Well, sorry, this is not about you, but it's about the company. And the company is everybody in it. It's the investors, it's the employees, it's the team, it's the advisors. Taking that outside money gives you that first brush and that blush with that outside corporate governance, which grants may or may not, because you know, you'll get another grant. And I think the behavior of taking outside money, I think the reason to take capital from outside is not for the capital, it's for everything that comes with it. I think the capital is incidental. There's so many ways to get that capital.
Okay. We are almost at 1:30, but I want to ask you sort of one last question, Sanjay. If you can just think ahead for the next decade, is there something you see in this whole startup scene and funding that's going to be qualitatively different from what it has been in the past decade? Is there something that has come to your mind that I think the world is looking more like this than
You
it
know,
was?
I'll take two personal examples, Professor. Both you and I are US persons, and we're sitting in India as we're on this webinar, right? You're in LA, I'm in San Francisco, and I'm assuming you're in Hyderabad. I'm sitting here in Bombay.
Yeah, yeah.
And we're sitting here talking about India in India right now today. Uh, you asked me about the last decade. I'm going to talk about the last 2 decades. When Karthik and I went out to start Bloom, we would get questions at three different layers. Our presentation had to have why India. We'd have 20 slides on why India. Then we get to why venture, and then we get to why Bloom. And we'd barely get to why venture. We had to just convince people about India. And today, I think what Modi ji has done, and regardless of political affiliations and what the how involved the government is, and the infrastructure has been set up. I mean, we are leading the world, right? And in the sense of the excitement, I mean, of the developing world. And the reason that's important is that is what's driving the investment. That is what's driving the investor interest. We don't need to have even one slide on why India today in our deck.
Yeah, right. Absolutely.
And what is that? I was speaking at the Columbia India Business Conference last year, and I can't tell you the number of the interest from alums who want to come back to India and either join startups or start something or do jobs. That was not the case, 1 or 2 decades ago. So that is also driving talent, which is very, very important for the startup ecosystem. All funds are raising more capital. I will say that we're investing more diligently. We're investing in a slower way, which is healthier. We're taking our time. We're not rushing. So there are people setting up India dedicated India funds. You have strategics that are coming in, or they're setting up Singapore offices or Middle East offices and actively look at India, having an India pocket, and you have talent. So all these factors are coming together. And of course, in fact, Sumangal has shared the IVA report. A lot of this captured in what's happening in India, not just in the metros, but out of it. I would say a big development process also. You look at the infrastructure developments. I'm sitting here in Bombay, look at my window, you look at the Sea Link and the metro projects, which will, of course, cause a lot of pain for 1 or 2 years. But once it takes off, the new airport that's built infra is also taking off. So very, very bullish for all these reasons. Talent is the most important. The fact that, your students are going to shape the future of tomorrow's startups and work with them is also, that's a reason for the bullishness.
What a fantastic way to really spend the last 90 minutes with you, Sanjay, on the National Startup Day. You gave answers that were very specific. You also gave philosophically deep answers. Really a great big thank you to you. And I hope all of you enjoyed it. I don't know if there's a way of giving a big round of applause, but I'm going to do this. Thank you very much, Sanjay. And thank you, Sumangal, for joining us.